to check the substance of transaction, whether it is compulsory payable or it is at the discretion of the entity, whether it's a financial liability or it is an equity. Then we had to check the component evaluation. Then we had discussed the component evaluation. Like in case of discretionary dividend, it is to be treated as equity because it is at the discretion of the management whether they will declare dividend, they will pay dividend or not. There is an obligation at the hand of the entity to pay cash or not. It is a discretionary at the option of the management. Then mandatory dividend payable, so it will be treated as a financial liability because it is an obligation of the management to pay cash. Then redeemable preference shares. In case of redemption, there is an obligation of an entity to pay cash after maturity. So it will be treated as a financial liability. But if it is in case of conversion, it should be check whether fixed to fixed criteria meet. If fixed to fixed criteria meet, then it will be treated as equity. If fixed to fixed criteria doesn't meet, then it will be treated as financial liability. In case of compulsory redeemable preference shares, at the option of the holder, then if the holder will redeem that after a period of time, it is at the option of the holder that they will redeem the option. Then it is an obligation of the issuer that they will pay cash. So it will be treated as a financial liability. But if it is at the option of the issuer that they will offer to the holder conversion option or redemption option. In case of redemption option, they will treat it as a financial liability. In case of conversion option, if then they will check whether fixed to fixed criteria meets or not. If fixed to fixed criteria meets, then they will treat it as an equity. If fixed to fixed criteria fails, then it will be treated as a financial liability. Then we had discussed about the compound financial instrument. What is compound financial instrument? It is a mixture of financial liabilities and equities. Because if in a transaction where there is a interest payable, but principal is convertible at the option of the issuer, whether and fixed to fixed criteria meets, then it will be treated as an equity, and interest is to be payable, then it will be treated as financial liability. If both the component is present in a single transaction, then it will be treated as a compound financial instrument. Then we had discussed about the concept of early redemption, how it is to be accounted for. Then we had discussed what now we will discussing the remaining concept under these standards, like where transaction does not result into financial liability. Which transaction are not results into a financial liability? Like history of distributing dividend. If there is a history of distributing dividend of an organization, they will that does not result into a financial liability. It is a history of an organization that they will distribute dividend, so it will be not recognized as a financial liability. Intention of distributing dividend does not result into a financial liability. Only just thinking that they will declare dividend or distribute dividend does not result into a financial liability. Non-distribution of dividend may impact reserve and surplus, does not result into a financial, because an entity has declared but not distributed, it will impact the reserve and surplus, but it will not treated as a financial liability. Non-distribution of dividend may impact future profit, does not result into a financial liability. So these are the transactions which does not result into a financial liability. Now some of the transactions are there which may be treated as a financial liability in case they are of equity nature. still they will be treated as a financial liability. Transaction which results into a financial liability, where the company has taken a loan in foreign currency and the repayment of loan is to be made in foreign currency. Company has taken a loan in foreign currency and repayment is also done in a foreign currency. But lack of access of foreign currency does not mean that it is not a financial liability. Suppose entity is having taken a loan in foreign currency amounting to rupees 10 lakhs, 10 lakh dollars. But somehow the entity is unable to get foreign currency for repayment because there is a lack of foreign currency in the market, so they will not able to purchase the dollar in order to repay back to the company from where they had taken a loan. So lack of access means lack of foreign currency does not mean that it is not a financial liability. So it will still be treated as a financial liability. Suppose X Limited has taken a loan from foreign bank amounting to 10 lakhs dollar, because, but in order at the time of repayment they will not get the foreign currency from the market. So such loan will still be classified as a financial liability. See, due to lack of access of foreign currency does not mean that it does not result into a financial liability. Such loan will still be classified as a financial liability. Again, the next point is restriction on transfer or repatriation of fund. Suppose a restriction on transfer or repatriation of fund does not avoid financial liability. This is to be explained with the help of example. Suppose H Limited, which is an Indian based company, has given a loan of $1 million dollar to its subsidiary company, which is a foreign company, which is in USA. But in the same transaction, the S Limited has restriction on transfer of fund to H Limited because S Limited does not have some legal issues, so they will not able to transfer the fund to H Limited. Still, such loan is to be recognized as financial liability in the books of S Limited. Restriction on transfer of fund does not or cannot avoid financial liability recognition. So it may be said that in case of lack of access of foreign currency does not mean that it will not result into a financial liability. Restriction on transfer repatriation of fund does not mean that it does not avoid the treatment of financial liability. Still be recognized as a financial liability. And settlement of financial instrument through transfer of non-financial asset. Settlement of financial instrument through transfer of non-financial asset does not avoid recognition of financial liability. This is again explained with the help of example. Suppose A Limited sold goods to B Limited and B Limited pay rupees 1 lakh. There is a liability in the hand of B Limited to pay 1 lakh to A Limited. So in the books of A Limited, there is a right to receive cash from B Limited, and in the books of B Limited, there is an obligation to pay cash to the B Limited. And in the books of A Limited, it will show debtor to B Limited as a trade receivable, and the books of B Limited, they will treat A Limited as a creditor. But at the time of settlement, B Limited does not have cash to pay to the A Limited. So they will decide to make a settlement in non-financial asset, that is PPE, rather than cash. So, but if settlement between A and B is to be done in PPE rather than cash on bank, because B Limited does not have cash to pay. So means B Limited will pay property, plant and equipment to A Limited instead of cash and bank. Still the amount payable of rupees 1 lakh will be recognized as financial liability. In this transaction also, If there is a transfer of non-financial asset in order to settle the financial instrument or financial liability, still that amount payable is to be recognized as financial liability in the books of B Limited. Now we will discuss about the callable financial instrument. What is a callable financial instrument? Callable instrument means where issuer has the right to call the instrument before maturity. Means right to purchase the instrument before maturity, where the issuer has the right to buy the instrument before maturity. That instrument is favorable to the issuer in case, because callable instrument is favorable to the issuer, those who issue, and adverse to the holder. In call option, generally fair value of call option is deducted from the value of the financial instrument. मीन्स कॉल ऑप्शन में फेयर वैल्यू ऑफ कॉल ऑप्शन को रिड्यूस किया जाता है फ्रॉम द वैल्यू ऑफ द फाइनेंशियल इंस्ट्रूमेंट. दिस इज टू बी एक्सप्लेन विद द help of example. Suppose market rate of interest of non-callable, non-putable instrument is 10% and value is rupees 1000. Fair value of call option है 100 rupees. Determine the fair value of callable instrument. So fair value of non-callable, non-putable means non-callable, non-putable का वैल्यू है जो कि आपका पुट कॉल नहीं है. जनरल वैल्यू है 1000 रुपीज, पर उसमें से फेयर वैल्यू ऑफ कॉल ऑप्शन 100 है. तो generally fair value of call option is deducted from the value of financial instrument. Value of financial instrument is 1000, and in case of call option, fair value of call option is to be reduced from the value of financial instrument. So value of fair value of call option is 100. So fair value of callable instrument becomes 900. So in this way, the example, with the help of example we had discussed, in case of call option, generally fair value of call option is reduced from the value of financial instrument. Now we will take one example in order to clear the call option. Illustration 1, D Limited issue preference shares to G Limited for consideration of rupees 1 lakh, 10 lakhs. Means D Limited issue preference shares to G Limited for a consideration of rupees 10 lakhs. The holder has an option to convert these preference shares to fixed number of equity instrument of the issuer anytime up to period of 3 years. If the option is not exercised by the holder, the preference shares are reduced at the end of 3 years. Are redeemed at the end of 3 years. Means they have an option to exercise or they have option to redeem after 3 years. If the option is not exercised by the holder, the preference shares are redeemed at the end of the preference share carry a coupon of RBI base rate plus 1% and is payable at the end of every year. Means coupon is to be paid every year. At the end of every year, the prevailing market rate for the similar preference share without conversion feature or issue redemption option in RBI base rate plus 4%. On the date of contract, RBI base rate is 9%. So generally, a market rate is 9% plus 4%, it becomes 13%, and the instrument coupon rate is 10% because 9% is the RBI base rate plus 1% is the coupon. So 10%. Additionally, the instrument gives an option to delimited to call back the preference share anytime during 3 years. The fair value of call option, that is the early redemption feature, is rupees 29,165. Now calculate the value of the liability and equity component. Now we will calculate the value of liability and equity component. Firstly, we will determine the issue price of preference shares. How much? Preference shares का issue price है 10 lakhs. Now calculate the coupon or interest paid, rate of interest at the time of issue. That is 9 plus 1, that is the own instrument rate, and market rate will be 9 plus 4, that is 13%. So coupon will be 10 lakhs का 10%, that is 1 lakhs. Every year the entity is to be paid. Interest, present value of cash outflow, that is 10 lakh ka 10%, that is 1 lakh. Present value factor, that is 13% for 3 years, that is the interest component, and at the end of 3 years 10 lakhs. Present value factor, that is 13% at the end of 3 years. This is the value of the financial instrument from which the value of callable, fair value of callable instrument is to be reduced. That is 29,165. So the calculation of present value of cash liability component is 9 lakhs, 9 lakh point 42. Now calculation of equity component, that is 10 lakhs minus 9 lakh point 42, that is the balancing figure 99,999.58. Now accounting entry at the initial recognition at fair value, that is bank account debit by 10 lakhs to liability component of preference shares, by 9 lakhs to equity component of preference shares, that is 99,999.58. Now this is the example which we had discussed about the callable option. Now we will discuss about the putable option. What is a putable instrument? It is a right of the holder to sell the instrument. It is at the holder's option that they will sell the instrument, and the issuer has to repay the price for the same. So holder has the right to sell the instrument anytime, and the issuer has to pay for the same. It is favorable. This transaction is favorable to the holder and adverse to the issuer. In put option, generally fair value of put option is to be added. In case of fair value or put option, in case of callable instrument, it should be reduced from the value of financial instrument. But in case of put option, it should be added. Fair value of put option is to be added to the value of financial instrument. Suppose this is to be explained with the help of example. Suppose A Limited hold 70% stake. A Limited hold 70% stake in XYZ Limited, and B Limited holds 30% stake in the same company, like in XYZ Limited. Investor A has the right to sell the shares back to, means investor A has an option to sell back the shares to XYZ Limited if IPO does not come in the next 5 years. So in this case, if IPO does not come and investor A Limited exercise its rights, like it will sell his shares to XYZ Limited. Can XYZ Limited pay cash to A Limited or not? Yes, XYZ Limited need to pay. It is an obligation to pay cash to A Limited, because A Limited has a right to exercise put option. So XYZ Limited has need to pay cash to A Limited, as it is an obligation to deliver cash, that is financial liability in the books of XYZ Limited. Where the holder, that is A Limited, investor, has the right to put the instrument back to the issuer, such instrument is called a putable financial. Means जहाँ पे होल्डर के पास राइट है कि वो अपने इंस्ट्रूमेंट को सेल कर सके to the issuer, then that instrument is to be treated as putable instrument. It is favorable to the holder and adverse to the issuer. Shall be recognized. Putable financial instrument shall be recognized as financial liability in the books of issuer, because in the books of issuer it's an obligation to pay cash. Now we will discuss about the equity. What is before going to the exemption? Some exemptions are there in case of putable financial instrument. That is transaction, that putable transaction will be treated as equity only, not as a financial liability, because exemption is given provided in that transaction, so it will be that putable option, that are putable instrument, but still they are recognized as equity, not as a financial liability. In general, all the putable instruments are recognized as financial liability, except some of the transactions which are discussed, which we are going to discuss. Except that, all the putable instrument will be treated as financial liability. What transaction are to be treated as equity? Firstly, we will discuss again the definition of equity, because in order to understand the exceptions, we firstly refresh our definition of equity. So, equity instruments, what are they? These are the instruments which evidence the residual interest in the asset of the entity after paying all its liabilities. Like equity share capital is an equity instrument. Say application money, pending allotment, contract to be settled in own equity instrument, that is receive fixed to fixed test criteria meets. If fixed to fixed test criteria meets, then it should be treated as an equity. Irredeemable bond means which will not redeemed, or preference shares with discretionary interest or dividend, that all are treated as an equity. Generally, putable instrument is a financial liability, but in some exception, these in some cases this is to be treated as an equity. What condition is to be fulfilled in order to treat the putable financial instrument as an equity, which we are going to discuss now. Like exception of putable financial instrument. Financial instrument is equity. Some of the financial instrument is equity. What are they? Some exceptions are given by in this standard. There are two categories of instruments. Like firstly, we will check the two category. What the category is? Holder has the right to demand. Holder has the right to demand redemption at his choice. If the holder has the right and the option to demand redemption at his choice, like for example, unit of open-ended mutual fund, then in that case, an obligation arising on liquidation, if any liquidation happen, in case of entity having an agreed liquidation date, for example, shares of limited life of joint venture, or unit of closed-ended mutual fund scheme, agreed liquidation date, then in that case, in order to check, firstly we will check these two categories. In order to do that, 5 conditions need to be fulfilled in case of financial instrument in order to determine whether they will recognize that instrument as a putable instrument as equity or not. Holder is entitled to prorata of shares on liquidation. Such putable financial instrument is considered as an equity. Means prorata number of shares on liquidation. If the holder is entitled for prorata number of shares on liquidation, then such putable financial instrument is considered as an equity. This is to be explained with the help of example. Suppose ABC Limited has two classes of putable shares, like class A shares or class B shares. On liquidation, class B shares are entitled to pro rata shares of entities, residual asset up to a maximum of 10 lakh. Class B shares. Because in this case it is written that up to a maximum of 10 lakhs. But Class A shares are entitled to residual interest on liquidation. As the definition of equity shares suggests that an entity, after paying all its liabilities, having a residual interest, is to be treated as equity. There is no in definition, there is no such mention that up to a maximum number of 10 lakh shares also will be treated as an equity. So class A shares are to be treated as equity, and class B shares is to be treated as a financial liability. Now, as the equity definition says, having a residual interest, so class A shares are equity and class B shareholders are not entitled to equity. As in the definition of equity, nothing is mentioned about the maximum number of shares. So it should not be in the nature of equity. So it tends to financial liability, because there are two classes of shares, like class A and class B. And in class A shares, which are entitled to, class A shareholders are entitled to residual interest on liquidation, and class B shareholders are entitled to maximum number up to 10 lakhs. So they in class B shareholders, number of shares are mentioned, but in the definition of equity there is no such mentioning that number of shares are treated as equity. Only it talks about the residual interest. So class A shareholders are treated as equity because they fulfill the definition of equity, and class B shareholders are treated as a financial liability. This is the exception. Then again we will talk about the exception 2. Instruments are subordinate to all other classes of instruments. Like, if any instruments are subordinate to all other classes of instruments, that is, they would receive money only on liquidation. Means no priority over other class of on liquidation. Means on liquidation, after paying all its liabilities, like any bank loan dues, any income tax dues, any payment to third party, any other payable, trade payable, loan payable, after paying all the liabilities, preference shareholders, payment to preference shareholders, if any amount left, that is to be paid to the equity shareholders. So it means instruments are subordinate to all other class of instrument. That means they would receive money only on liquidation, means no priority over other claims on liquidation. Equity shareholders are having last priority to get the payment, means they are equity shareholders has having a last priority. After paying all its liabilities, they will get the leftover. For example, Y Limited has made investment in mutual fund X. So last for payment, most subordinate class having residual interest, then such instrument shall be equity in nature for mutual fund company. If they are treated as last for payment, and they are treated as subordinate classes and having residual interest, then it will be treated as equity in nature for mutual fund company. Now exception 3, all putable financial instrument in most subordinate classes shall have identical feature. Mean the features are identical. In case if the features are not identical, then they are not treated as an equity. For example, formula for computing redemption price. Suppose Tata Motor has reissued putable ordinary shares, and putable ordinary shares and putable A ordinary. Two shares the Tata Motor has issued. One is putable ordinary share and putable A ordinary shares. And features are not identical, because in putable ordinary shares, one vote per shares is there, and in putable A ordinary shares, no voting rights is to be given. Features, no asset, net asset on liquidation, and in both the cases net asset. So all the features are not identical. Some features are identical and some features are not identical. What are the identical features? That net asset on liquidation on both the cases, but voting right is not the same, because in case of putable A ordinary instrument there is no voting right, and in putable ordinary shares there is a voting right, one vote per share. So the features are not identical. In case if the features are not identical, then it should be treated as equity. Since all the features related to instrument, that is putable ordinary shares and putable A ordinary shares, are not identical, and hence such shares are recognized as financial liability and not in. So if all the instruments having a identical feature, then it should be treated as equity. If any of the features are not similar, then it should be treated as financial liability. So in order to recognize putable financial instrument, all the features must have an identical, uh, means all the subordinate class should have an identical features. Then only it should be recognized as equity, otherwise it will be recognized as financial. Now exception 4, no contractual obligation to pay cash or bank. In case of equity, there is no contractual obligation to pay cash bank. Number of shares to be issued are fixed and amount of consideration are also fixed. Now suppose T Limited issue putable ordinary shares to S Limited. T Limited is having an option to convert into equity based on the market price of the shares. These putable ordinary shares is converted into equity shares based on the fair value or market price of the S Limited. So number of the shares to be issued are variable. Fixed to fixed criteria will fail. Hence this results into financial liability because it is not fixed. In this case, the number of shares issued are not fixed. Fixed to fixed criteria fails and hence it will be treated as financial liability, not as an equity. Now exception 5, where total expected cash flows attributable to the financial instruments over the life of the instrument are based substantially on the profit and loss, change in the recognized net asset, or change in the fair value of the recognized and none or and unrecognized net asset of the entity over the life of the instrument, excluding any effects of the instrument. Means if the cash flows are attributable to any factors other than these three listed above, for example, an index putable instrument will fail the equity classification. This is to be explained with the help of example. Suppose Y Limited has issued putable final ordinary shares to X Limited. At the same time, X Limited entered into AMC contract with Y Limited. Now, X Limited is that is the holder of the instrument entitled to 50% of profits of Y Limited. Solution: the putable ordinary shares cannot qualify for equity classification as, in addition to the put option, there is another contract because one entity enter into a put option, another entity enter into AMC contract. So there is another contract between the issuer and a holder of the putable instrument whose cash flows are based substantially on the profit and loss of the issuer, whose contractual terms are not similar to contract between the non-instrument holders and the issuers. It has the effect of substantially restricting returns on putable ordinary shares. That means it is not in the nature of equity because the terms are not similar or in line to the instruments. So it will be not treated as equity, it will be treated as financial liability. But if it fulfill the condition, that then it will be treated as an equity. These 5 exceptions or conditions to be tested only if an investment has putable feature or a limited life based on agreed liquidation. These conditions need not be tested for regular equity shares which are neither putable nor carry a limited life. Means these 5 exceptions or condition only tested if the investment is having a putable option features or having a limited life based on agreed liquidation. These conditions are not required to be tested for regular equity shares with neither having a putable option nor carry a limited limit. NCI put option is available to NCI shareholders to sell their shareholding or interest to the majority shareholders. Means this option is available to the shareholders who sell their shareholding or whatever interest they have to the majority shareholder. In this case, H Limited is the holding 80% stake in ABC Limited and S Limited holds 20% stake in ABC Limited. So S Limited has a put option to sell 20% stake to H Limited. Means they have who are the NCI shareholders. The H Limited are the NCI shareholders who sell their shares, who sell their put option, which is the 20% stake to H Limited. So this option is available to the shareholders who sell their shareholding to the majority shareholder. Majority shareholder is H Limited who hold 80% stake in ABC Limited, whereas S Limited holds 20% stake in S Limited. So S Limited has a put option to sell their 20% stake to H Limited. So in this case, H Limited is recognizing such put option which is available to S Limited as financial liability at fair value. So journal entry in the books of H Limited becomes deemed investment account debit, which is at fair value to financial liability. In the books of journal entry in the books of S Limited becomes to be treated as derivative, that is fair market value minus mark to market. Mark to market to be done for such derivative. Settlement through own equity shares. Now this will be a scenario in case of convertible instrument. In case of convertible instrument, generally settlement is to be done through own equity shares. Suppose this is to be explained with the help of example. B Limited issuer, who is an issuer, issue convertible preference shares to A Limited, who is the holder of the instrument. Means A Limited is the holder of the instrument and B Limited issued convertible preference shares. Now, these convertible preference shares to be converted into equity shares of B Limited. Means there is an option that these preference shares after some period of time it will be converted into equity shares of B Limited who issue these preference shares. Now, how we will evaluate? Firstly, we will check the fixed to fixed criteria. Now, if in case of scenario, there are some scenarios. In scenario 1, if number of shares to be issued are fixed and consideration is also fixed, then it will be treated as equity. It will be an equity in nature. Then we will recognize this instrument as equity. In scenario 1, if the number of shares to be issued are variable, it depend on the future date. Number of shares to be issued is not fixed and consideration is fixed, then it will be considered as financial liability as a holder is exposed to risk because the shares are not fixed. In case of scenario 3, if number of shares to be issued is fixed but consideration is not fixed, consideration is variable, it depends on the future fair value of the shares, so it will be considered as a financial liability. In case of scenario 4, if a number of shares to be issued are variable and consideration is also variable, fixed to fixed criteria fails, then it will be considered as a financial liability. So, what do you mean by variable number of shares? We will first discuss. Variable number of shares means where shares to be issued are not fixed on the transaction date and is variable in nature. On the transaction date, when they enter into transaction, the number of shares are not fixed, the consideration are not fixed, then it will be treated as variable in nature. For example, number of shares is dependent on the fair market value on the date of conversion. On the date of conversion, if the number of shares is dependent on the market value, then it will be considered as a variable number of shares. But on the date of transaction, when it is fixed, number of shares is also fixed and consideration is also fixed, then it will be treated as an equity. This is to be explained with the help of example. Suppose in example 1, A Limited is there and B Limited is there. B Limited issued convertible preference shares of 10 lakh. Rate of interest is 10% to be converted into fair market value of B Limited shares after 10 years. Means period is 10 years and it will be converted into B Limited shares. Number of shares, how to determine fair market value per share? Number of shares into fair market value per share equals to total consideration. Here total consideration is given 10 lakhs. But number of shares and fair market value per share is not given. So both are variable. Number of shares are also variable but consideration is fixed. Then if the number of shares are variable, fair market value per share is variable, depend on the after for 10 years, but consideration is fixed, then it will be treated as a financial liability. Here convertible preference shares will be treated as financial liability, and dividend, if dividend is discretionary at the decision of the management, then it will be treated as equity. If there is a component of both the instrument, that is the convertible preference share which is treated as financial liability, and dividend which is discretionary in nature, depend on the management decision, then it will be treated as equity. If both the component is present in the financial instrument, then it will be considered as a compound financial instrument. Now in example 2, suppose A Limited is there and B Limited is there. B Limited issue convertible bond to A Limited amounting rupees 10 lakhs. Rate of interest is 10% to be converted into 10,000 shares. Here number of shares is given after 10 years. Now number of shares is also given, total consideration is also given. Then fixed to fixed criteria meets. If number of shares, that is 10,000 shares is given and total consideration, that is 10 lakhs is to be given, the balancing figure becomes the fair market value per share. So if fixed to fixed criteria meets on the conversion, then it will be treated as equity. And interest is always a cash obligation to pay to the issuer company, to holder company. So interest is a financial liability. In this transaction also, both the element is present, equity element and financial liability. Then it will be treated as a compound financial instrument. If both the in a single transaction, if both the element is present, both financial liability and equity, then it will be considered as a compound financial instrument. Now the other concept is treasury shares. Treasury means treasure. Treasure means it's a kind of khazana. Company has made investment. If the company has made investment in its own shares, then it will be considered as a treasury. अगर कंपनी अपने ही शेयर्स में इन्वेस्टमेंट करती है, कैसे? थ्रू ओपन मार्केट, परचेज फ्रॉम ओपन मार्केट, यहाँ से ओपन मार्केट परचेज करके या इशू करके एक ट्रस्ट फॉर्म करती है, उसमें अपना शेयर्स को इशू करती है. कैन बी इशू टू ट्रस्ट फॉर द पर्पस ऑफ ईशॉप टू बी इशूड इन फ्यूचर, टू बी यूज्ड इन फ्यूचर. क्योंकि ईशॉप के पर्पस के लिए अगर कंपनी अपना ही शेयर इशू करती है ट्रस्ट को, तो वो ट्रेजरी शेयर्स बोला जाता है. अगर कंपनी इन्वेस्ट करती है अपने ही शेयर्स में और उसको परचेज करती है फ्रॉम ओपन मार्केट या इशू करती है टू द ट्रस्ट, किस चीज के लिए? फॉर द पर्पस ऑफ ईशॉप विच इज टू बी यूज्ड इन फ्यूचर, सो उसको ट्रेजरी शेयर बोला जाता है. सच ट्रेजरी शेयर्स शैल नॉट बी रिकॉग्नाइज्ड एज इन्वेस्टमेंट. उसको अपने बैलेंस शीट में कभी भी उसको इन्वेस्टमेंट की तरह नहीं दिखाया जाता है. रैदर सच ट्रेजरी शेयर्स शैल बी रिड्यूस्ड फ्रॉम इक्विटी, अकाउंटेड एज रिडक्शन फ्रॉम इक्विटी. जैसे कि प्रेजेंटेशन इन बैलेंस शीट, इक्विटीज आप दिखा रहे हो 10 लाख शेयर्स इशू किया है उसमें लेस कर दीजिए ट्रेजरी शेयर, जितना भी ट्रेजरी शेयर्स है, तो उसको इन्वेस्टमेंट बोल के नहीं दिखाया जाता, उसको इक्विटी से रिड्यूस करके दिखाया जाता है। और कोई भी गेन एंड लॉस ऑन ट्रेजरी शेयर्स शैल बी रिकॉग्नाइज्ड इन पीएनएल। सो ट्रेजरी शेयर्स एक तरह से इन्वेस्टमेंट करती है कंपनी अपने ही शेयर्स में, या तो परचेज करती है ओपन मार्केट में, या इशू करती है ट्रस्ट को, एक ट्रस्ट फॉर्म करके उसको इशू करती है। किस लिए इशू करती है? फॉर द पर्पस ऑफ ईशॉप विच इज टू बी यूज्ड इन फ्यूचर। शायद उस ट्रेजरी शेयर्स को वो इन्वेस्टमेंट कभी नहीं दिखाती, उसको इक्विटी से रिड्यूस करती है, फ्रॉम रिडक्शन फ्रॉम द वैल्यू ऑफ इक्विटी। और कोई भी गेन और लॉस होता है ट्रेजरी शेयर्स में तो उसको रिकॉग्नाइज करती है। So dividend accounting, there is a two classification, that is if dividend on instrument is to be classified as equity, then it will be recognized in the year in which it will be declared, like not in the year in which it pertains. Means dividend in case of equity instrument, it will be recognized in the year in which it declared, and journal entry will be retained earning account debit to proposed dividend, and at the time of making payment proposed dividend account debit to bank. Any dividend distribution tax or related taxes is to be adjusted with equity only. But in case of dividend on instrument, if it is classified as liability, it will be classified when the dividend, when there is a mandatory redeemable preference share, and that time dividend is to be paid in the form of interest, not a discretionary dividend. In case of equity, dividend is discretionary, and if it is paid by the management on the decision of the management, when it is declared, then it will be recognized in the year in which it declared. But in case of mandatory redeemable preference share, if dividend is to be paid, it will be recognized as financial liability, and dividend will take the nature of interest. Interest is to be recognized in the year in which it pertains. Means the journal entry will be finance expense account debit in the books of the issuer. It will be recognized as finance expense account debit to accrued interest, and any related distribution, dividend distribution taxes is to be included in the finance cost. Now, offsetting of financial asset and financial liability, how it is offsetted? Generally, Index will not allow any financial asset and financial liability to be offsetted with each other. Financial asset and financial liability cannot be offsetted against each other. Such financial asset and financial liability need to be recognized separately in the financial statement. It should be shown separately in the financial statement. It should not be offsetted with each other. Offsetting of financial asset and financial liability does not mean the de-recognition of financial asset and financial liability. Financial asset and liability can be offsetted only if the following conditions are satisfied. Like if the company has a legal right to offset the financial asset and financial liability. If the company has a legal right to offset the asset and liability, then only they will able to offset the transaction. And if the company has an intention to settle the financial asset and financial liability on net basis, if the company has an intention, company want that they will settle the financial asset and liability on net basis, then only they will able to offset. Like in case if the debtors are there, if the creditors are there of the same entity, then if they want to settle that on net basis, then only they will able to offset that transaction. Suppose A Limited gives loans to H Limited, and H Limited passes this loan to S Limited. ए लिमिटेड से आपने लोन लिया है, मतलब एच लिमिटेड विच इज ऑन होल्डिंग कंपनी, एच लिमिटेड ने लोन लिया ए लिमिटेड से, और एच लिमिटेड होल्डिंग कंपनी ने अपनी सब्सिडरी को वो लोन पास कर दिया। तो फैक्ट ऑफ द ट्रांजेक्शन क्या है? ए लिमिटेड ने लोन दिया एच लिमिटेड को, और एच लिमिटेड पासेस द लोन टू एच लिमिटेड। एच लिमिटेड ने उस लोन को यूटिलाइज नहीं किया फॉर इट्स ओन पर्पज। एच लिमिटेड कैनॉट चार्ज इंटरेस्ट मोर देन द रेट ऑफ इंटरेस्ट चार्ज बाई ए लिमिटेड। ए लिमिटेड जो रेट ऑफ इंटरेस्ट एच लिमिटेड से चार्ज करेगा उतना ही इंटरेस्ट एच लिमिटेड एस लिमिटेड से चार्ज करेगा, नॉट मोर देन दैट। बिकॉज जब तक एस लिमिटेड एच लिमिटेड को रीपे नहीं करेगा वो अमाउंट, हाउ कुड एच लिमिटेड विल पे the loan amount to A limited? So when the S limited will make the payment of that loan to H limited, then only H limited will make further payment to A limited. If S limited, अगर सब्सिडरी कंपनी फेल हो जाती है मेक पेमेंट टू H लिमिटेड को, होल्डिंग कंपनी को, देन होल्डिंग कंपनी इज अंडर नो ऑब्लिगेशन टू पे A लिमिटेड। होल्डिंग कंपनी एक एजेंट की तरह काम कर रही है। H limited is working as an agent only for operating the S limited. It seems that H limited is only operating as an agent for S limited. If both conditions of Index 32 get satisfied, then this loan will be recognized on net basis. Means आप एच लिमिटेड के बुक्स में भी वो फाइनेंशियल लायबिलिटी डिस्क्लोज होगी और एस लिमिटेड के लिए एस लिमिटेड के बुक्स में भी वो फाइनेंशियल लायबिलिटी ही दिखाई जाएगी। अगर दोनों कंडीशन फुलफिल करता है देन ओनली द लोन विल बी रिकॉग्नाइज ऑन नेट बेसिस। नाउ इक्विटी conversion option embedded in foreign currency. If any equity conversion option which is embedded in foreign currency, suppose entity A issue a bond to another company B limited. A limited ने एक बॉन्ड इशू किया अनदर कंपनी B लिमिटेड को of 100 USD, $100, रेट ऑफ इंटरेस्ट इज 6%, कन्वर्जन है फिक्स टू फिक्स मीट विच इज इक्विटी इन नेचर। फिक्स टू फिक्स क्राइटेरिया मीट हो रहा है जो कि इक्विटी इन नेचर है। ए लिमिटेड ने एक बॉन्ड इशू किया 100 USD का टू बी लिमिटेड, रेट ऑफ इंटरेस्ट 6% का है, कन्वर्जन इज फिक्स टू फिक्स क्राइटेरिया मीट हो रहा है विच इज सो इट इज इक्विटी इन नेचर। नाउ द प्रिंसिपल अमाउंट इज in USD, like principal amount is USD converted into fixed number of shares, so fixed to fixed criteria meets, so it will be treated as equity. Principal amount is treated as equity as per Ind AS. Interest मैंडेटरी पेएबल, इंटरेस्ट को मैंडेटरी पेएबल है तो ये फाइनेंशियल लायबिलिटी का फीचर है, सो एज पर Ind AS इट विल बी ट्रीटेड एज फाइनेंशियल लायबिलिटी। बट एज पर IFRS क्या बोलता है, अगर कोई भी बॉन्ड इशू करता है जो कि USD फॉरेन करेंसी डिनोमिनेटेड इन फॉरेन करेंसी, देन एनी फ्लक्चुएशन, एनी फॉरेन रेट फ्लक्चुएशन उसमें होता है तो उसको हम ना इक्विटी नहीं मानेंगे, हम उसको फाइनेंशियल लायबिलिटी ही मानेंगे। उस अमाउंट को हम फाइनेंशियल लायबिलिटी ही मानेंगे जो डिनोमिनेटेड है इन फॉरेन करेंसीज, बिकॉज देयर इज अ फ्लक्चुएशन ड्यू टू फॉरेन करेंसी। बट एज पर Ind AS बोलता है कि अगर प्रिंसिपल अमाउंट है जो डिनोमिनेटेड है इन USD और अगर उसमें फ्लक्चुएशन भी होता है तो हम उसको इक्विटी ही मानेंगे, बिकॉज फिक्स टू फिक्स क्राइटेरिया मीट हो रहा है। बट IFRS बोलता है इवन फिक्स टू फिक्स क्राइटेरिया मीट हो, हमको उससे मतलब नहीं है। अगर प्रिंसिपल अमाउंट डिनोमिनेटेड इन फॉरेन करेंसीज में है तो वो उसपे फ्लक्चुएशन का इफेक्ट आता है तो हम उसको फाइनेंशियल लायबिलिटी ही मानेंगे। इंटरेस्ट अगर उसका कुछ पे कर रहे हैं मैंडेटरी पेएबल है तो एज पर Ind AS वो फाइनेंशियल लायबिलिटी है, IFRS के हिसाब से भी फाइनेंशियल लायबिलिटी। और अगर कोई भी एक एलिमेंट में एक ट्रांजैक्शन में सिंगल ट्रांजैक्शन में जहाँ की प्रिंसिपल इक्विटी नेचर का है और इंटरेस्ट फाइनेंशियल लायबिलिटी नेचर का है, तो उसको हम लोग कंपाउंड फाइनेंशियल इंस्ट्रूमेंट बोलेंगे. एज वन कंपोनेंट इज इक्विटी एंड अनदर कंपोनेंट इज लायबिलिटी, सो इट इज कंपाउंड फाइनेंशियल इंस्ट्रूमेंट. एंड उसका अकाउंटिंग स्प्लिट अकाउंटिंग की तरह होगा, बट आईएफआरएस उसको फाइनेंशियल लायबिलिटी ही बोलता है. ये कार्व आउट है बिटवीन दिस ट्रांजेक्शन एज पर इंडेस एंड एन आईएफआरएस, जो कि यूएसडी डिनोमिनेटेड इन यूएसडी. अगर फिक्स टू फिक्स क्राइटेरिया मीट होता है तब वो इंडेस के हिसाब से इक्विटी है, पर आईएफआरएस के हिसाब से फाइनेंशियल लायबिलिटी है. देन ये कार्व आउट है जो कि अवेलेबल है इन दिस गाइडेंस, or difference between the guidance available in INDES and guidance available in IFRS. So as thus equity conversion option embedded in foreign currency is equity in nature, because ये equity in nature है as per INDES, because any equity conversion option, कोई भी इक्विटी कन्वर्जन ऑप्शन एम्बेडेड इन फॉरेन करेंसी, देन इट विल बी ट्रीटेड एज इक्विटी इन नेचर एज पर इंडेस, बट इट विल बी ट्रीटेड as financial liability as per IFRS. So this will be the discussion which we had discussed. Now in the next two discussion, or in next two videos, we will try to complete our financial instrument topic. Most of the topic is covered. Some of the topics are still left. We will discuss in the next two videos. Thanking you for watching my video. Thanking you for watching my video. If you like, please share, subscribe my channel.